This book is not available anymore, and if you were to get one, it will cost over $2,000. Before I reveal the book, subscribe, like, and share. Seth Klarman's Margin of Safety isn't just a book, it's a value investing Bible. Let's delve deeper into its key concepts with real-world numerical examples to illuminate the path to potentially undervalued opportunities. Chapter 1 and 2. Discounts and net nets, quantifying the advantage. 1. Concept. The core principle, buying at a discount to intrinsic value, creates a margin of safety. 1. But how much of a discount? 2. Example 1. The value investor's dream. Imagine company, trades at $10 per share. 2. Through in-depth analysis, you estimate its intrinsic value at $20. 2. This translates to a 50% discount, $20, $10, and a potential 100% upside if the market recognizes its true worth. 2. A hefty margin of safety. 3. Example 2. Don't be fooled by face value. Company B trades at eighth, and its net current asset value, NCAV, is 7th. 3. This seems like a steal, 12.5% discount. 3. But further analysis reveals declining sales and a lawsuit that could cripple its financials. 3. The discount might be a mirage, highlighting the importance of quality alongside a price difference. Chapter 3, Beyond the Discount, Ratios. Unveiling the story. While a discount is enticing, a company's financial health is crucial. Here's where ratios come into play. 1. Return on equity, ROE, measures how effectively a company uses shareholder equity to generate profits. 1. A consistently high RO, say above 15%, might indicate a well-managed company with a strong track record. 2. Debt to equity ratio assesses a company's financial leverage. 2. A high ratio, above 2, suggests significant debt, which can be risky if the company struggles to make interest payments. Example, Company C trades at 15 teens with a 20% discount to its NCAV. However, its ROE is a measly 5%, and its debt-to-equity ratio is a concerning 3. While the discount is there, the financial weakness raises red flags. Chapter 4. Risk Management. The downside matters too. Value investing isn't just about potential gains. It's about protecting your capital. Consider the downside. 1. Downside. Protection. How much could the investment potentially lose in a downturn? A 20% upside might sound attractive, but if the downside risk is 30%, the investment might not be worthwhile. Example, Company D trades at $30 with a 33% discount to your estimated intrinsic value. Sounds promising, but the company operates in a cyclical industry prone to sudden drops. A potential 40% decline during a recession could erase any gains and leave you with significant losses. Chapter 5. And 6. Special situations. Intrinsic value as the anchor. Special situations like mergers and spin-offs can create buying opportunities. However, don't get swept away by the hype. 1. Intrinsic value as the compass. Even in a bidding war, understand the underlying company's value. 1. Don't get caught overpaying in the frenzy. Example, Company E announces a merger with a premium offered to shareholders. The stock price surges. While the premium might be enticing, analyze the post-merger company's financials and estimated intrinsic value. Is the stock price still justified, or are you simply buying into the excitement? Chapter 9. Learning from the masters. The power of the moat. Successful value investors like Warren Buffett focus on companies with a sustainable competitive advantage, a moat that protects their profits. 1. The moat's importance, a strong brand, loyal customer base, or efficient cost structure can all be moats. 1. Companies with these advantages might command a premium valuation, higher PE ratio, but their long-term growth prospects justify the price. Example, Company F has a dominant market share, brand recognition, and a history of innovation, all moats. While its PE ratio is higher than competitors, its ability to consistently generate profits and grow justifies the premium. Unlocking intrinsic value, unveiling the mystery. Estimating intrinsic value is an art, not a science. Here are 2 common tools. 1. Discounted cash flow, DCF. Estimate a company's future cash flows, discounted back to their present value, to arrive at an intrinsic value. 1. This requires assumptions about future growth and discount rates, making it somewhat subjective. Example: Company G is expected to generate $2 per share in free cash flow for the next 10 years, with the projected growth rate of 5% per year. 1. Assuming a discount rate of 10%, the DCF analysis might indicate an intrinsic value of around 35 FIs per share. Price-to-earnings ratio, PE, comparison. Compare a company's PE ratio to its historical average or industry benchmarks. A lower PE ratio might suggest a potential value stock. However, this method requires considering industry norms and growth prospects. Chapter 10. Putting it all together, the margin of safety calculation. Once you have an estimated intrinsic value, you can calculate the margin of safety, your buffer against potential errors. 1. Margin of safety, I intrinsic value, market price. Continuing with Company G's example, if it's currently trading at $30 per share, the margin of safety would be 5 for mind, 35 at 30. This 14% buffer protects you if your DCF analysis is slightly off, or if the market price experiences a temporary decline. Remember, these are simplified examples for illustration. Real-world security analysis is a multifaceted process. Financial statements, industry trends, qualitative assessments like management quality, and a dash of healthy skepticism are all crucial ingredients for determining a company's true worth and uncovering potential opportunities. By employing the value investing principles outlined in Margin of Safety and conducting thorough research, you can develop a framework to identify undervalued companies with a built-in margin of safety. This doesn't guarantee success, but it can potentially improve your chances of profiting from the market's inefficiencies over the long term. Disclaimer: this is for informational purposes only, and consulting with a financial advisor is essential before making any investment decisions.